Two headlines dropped in the same news cycle, and most people will treat them as completely unrelated. They are not. A woman was killed in a Tesla crash, raising fresh questions about autopilot, and SpaceX stock began selling off almost immediately after what was described as a blockbuster IPO. Strip away the surface details, and both stories are asking the same question. How do you price a system where the machine is making the decision and the human is absorbing the consequence? That question is worth serious money to get right. Let's start with what the headlines actually establish, and then separate that from what we can reasonably analyze. NewsNation is reporting a woman was killed in a Tesla crash, and the circumstances are raising questions about autopilot use. That is the factual baseline. We do not have confirmed specifics about exactly how the system was engaged, what the investigation has found, or who is being named in any legal action. What we can do is zoom out to the structural picture, because that is where the real investor and policy implications live. Tesla has faced autopilot-related investigations and fatalities before. The National Highway Traffic Safety Administration has conducted multiple formal inquiries. What has shifted in 2026 is the legal and regulatory terrain around these incidents. Courts and regulators are no longer treating autonomous and semi-autonomous driving features as experimental novelties with inherent forgiveness baked in. The standard of care expected from manufacturers is rising, and so is the sophistication of plaintiff attorneys who now have years of prior case law to draw from. The distinction that matters most here is between full autonomy and driver assistance. Tesla's Autopilot is legally classified as a Level 2 driver assistance system. The driver is required to remain attentive and in control, but the gap between how that is marketed and how it is actually used by drivers in the field has been a persistent source of tension and litigation. For investors, the actionable insight is this: every high-profile autopilot incident adds pressure to Tesla's regulatory posture, increases the probability of mandatory software restrictions, and potentially delays full self-driving certification timelines. None of those outcomes are priced as certainties, but they represent tail risk that serious Tesla bulls should be modeling explicitly, not dismissing. This is not a reason to short or buy. It is a reason to know what you own. Now to the second story. CNBC is reporting that SpaceX stock is falling pre-market, continuing a sell-off after what the headline describes as a rally and a blockbuster IPO. Again, let's be precise about what we know from the headline versus what we can layer in analytically. The fact pattern here is one of the most recognizable in public market history. A highly anticipated private company finally goes public. The IPO is described as blockbuster, meaning strong institutional demand, likely a pricing at or above the high end of the range, and a pop on day one or in early trading. Then the sell-off begins. This sequence is not a failure. It is a mechanism. Here is why this happens structurally. Pre-IPO, access to SpaceX equity was limited to venture capital, institutional private markets, and a small number of secondary market participants. The price discovery process was opaque. When a company of this profile finally hits public markets, there is an enormous release of pent-up demand, but also an enormous release of pent-up supply. Early investors, employees with vested shares, and institutional allocations from the IPO book all have the ability to sell into the initial enthusiasm. The rally happens. Then the distribution happens. This is sometimes called the IPO lockup dynamic, though in SpaceX's case, the specific terms of any lockup period matter significantly. What the headline confirms is that the sell-off is already underway, which means the market is going through the normal price discovery compression that follows a high-visibility debut. For context, this does not tell you whether SpaceX is overvalued or undervalued at current prices. What it tells you is that the first weeks of trading for a company of this profile are almost never the right entry point for investors who are not already positioned. The institutional book sets the IPO price. Retail sentiment drives the initial pop, and then fundamentals and patience determine what the stock actually does over the next 12 to 24 months. That is the pattern. Recognize it. Here is what ties both stories together, and why covering them in the same breath is not an editorial accident. We are in the middle of a decade-long transition where machine systems, autonomous driving algorithms, orbital launch vehicles with automated flight control, AI-driven decision engines across finance and logistics, are absorbing responsibilities that were previously held by humans. That transition creates enormous value. It also creates a new category of risk that markets are still learning to price. With Tesla, the risk is regulatory and legal. Each autopilot incident forces a question that does not have a clean, actuarial answer yet. When a machine makes a decision that results in a human death, how does liability flow, and what does that cost at scale? Insurance companies, courts, and regulators are building those models in real time. The companies whose technology is at the center of those incidents are part of that price discovery process, whether they want to be or not. With SpaceX, the risk is valuation and timing. SpaceX is arguably the most sophisticated launch infrastructure company on the planet. Its technological moat is real. But the IPO price reflects a very specific set of assumptions about growth trajectory, government contract continuity, Starlink revenue scaling, and competitive dynamics from international launch providers. When the stock sells off post-IPO, the market is not necessarily saying the company is bad. It is saying the price relative to those assumptions needs recalibration. The broader principle for anyone building a portfolio with exposure to AI and autonomous systems is this: the technology thesis and the valuation thesis are two separate things, and confusing them is an expensive mistake. You can be completely right that autonomous vehicles will transform transportation and still lose money on the equity if you bought at the wrong price or misjudged the regulatory timeline. This is not financial advice. It is the framework that separates investors from enthusiasts. Master that distinction, and you are already ahead of most of the market. We started with two seemingly unrelated headlines and ended with one core insight. Markets are still learning to price the risk of machine decision-making, and that gap is where serious money is either made or lost. The question we have not answered yet, and what the next video will tackle, is which other AI infrastructure plays carry the same IPO cycle risk that SpaceX is showing right now. If that is useful to you, subscribe. This channel exists for exactly that work,